Imagine a secret three-digit number that dictates the trajectory of your life. It is a shadow algorithm, a silent judge evaluating every financial move you make before you even step foot inside a bank lobby. This unseen metric determines the neighborhood where you can rent an apartment, the interest rate on the vehicle you drive to work, and in some sectors, whether you can even secure that job in the first place. Uncovering the hidden mechanics behind this pervasive system reveals a landscape shrouded in rumor and anxiety. We are navigating a world where common myths often obscure the mathematical reality, leaving millions to make critical errors based on outdated advice. Today, we are decoding the top 10 things that truly dictate the power of your financial reputation, stripping away the misconceptions to reveal the raw data underneath. Number 10 introduces the architects of this invisible ledger, the scoring models themselves. To understand the game, you must first identify the dual monoliths dominating the industry, the FICO score and the Vantage score. These are not government entities, but proprietary algorithms designed by private corporations. They act as universal translators, taking the chaotic, sprawling data of your financial life collected by major credit bureaus and distilling it into a singular, ruthless verdict of risk. Decades ago, securing a loan was a localized, highly subjective affair, heavily reliant on a handshake, a banker's personal judgment, and often inherent biases. The introduction of standardized scoring by the Fair Isaac Corporation in the late 20th century stripped away that human element. It replaced the local bank manager with a cold, impartial formula that weighs the ghosts of your past to predict the statistical probability of your future default. Number 9 stands as the absolute foundation of this predictive architecture, the unforgiving weight of your payment history. This single factor commands the largest share of your overall profile, accounting for a staggering 35% of the traditional calculation. It is the algorithmic equivalent of a heartbeat, a continuous rhythm of reliability that lenders monitor for any sign of a sudden alarming arrhythmia. A single missed deadline does not merely vanish when the balance is finally settled a few weeks later. Once a payment crosses the critical 30-day threshold past its due date, it embeds itself deeply into your permanent record, echoing through the system for up to 7 years. The models are entirely devoid of empathy. They do not care about the medical emergency, the lost job, or the narrative behind the late payment. They only register the binary truth of whether the contractual obligation was met. Number 8 introduces a mathematical trap that frequently ensnares the unwary, known as credit utilization. This is the delicate, constantly shifting ratio between the revolving debt you currently carry and the total limits extended to you across all your open accounts. Maxing out a credit card, even if you have the cash in the bank and fully intend to pay it off entirely at the end of the billing cycle, sends an immediate signal of severe financial distress to the algorithm. The system captures a snapshot of your balances at a specific moment each month, usually when the statement closes. If that snapshot catches you utilizing 90% of your available limit, your score drops instantly. The mathematical sweet spot is fiercely debated among financial analysts, but keeping this ratio well below 30% is widely considered the threshold for safety. Crossing that invisible line triggers a rapid descent, as the system interprets high utilization not as a convenience, but as a desperate reliance on borrowed capital. Number 7 reveals the illusion of financial tidying and the critical importance of credit age. Many consumers instinctively close old, unused credit cards, believing they are cleaning up their financial footprint and protecting themselves from fraud. In reality, this seemingly responsible action severs a vital lifeline to the past, often inflicting immediate collateral damage on their overall standing. Lenders crave stability above all else, and a lengthy, well-maintained history provides the ultimate proof of endurance. By terminating your oldest accounts, you artificially shorten your financial timeline. While a closed account in good standing may remain on your report for a decade, the immediate loss of its available credit can skew your utilization, and its eventual disappearance will cause the average age of your portfolio to plummet. The algorithm heavily rewards longevity, treating an aged, dormant account as a powerful testament to long term reliability. Number 6 exposes the hidden danger of the hard inquiry, a phenomenon triggered by new loan applications. Whenever you actively seek new lines of borrowing, whether you are applying for a 30-year mortgage, financing a new vehicle, or simply asking for a discount at a retail store checkout by opening their credit card, the prospective lender pulls your file for a comprehensive review. This action leaves a permanent, highly visible footprint on your report. A sudden cluster of these hard inquiries acts as a glaring red flag to the algorithms. It suggests that you are aggressively seeking capital from multiple sources simultaneously, perhaps to mask an impending personal crisis or a sudden loss of income. While a single inquiry causes only a minor, temporary dip of a few points, a rapid succession of applications can inflict severe, compounding damage that takes months of flawless behavior to heal. Number 5 explores the subtle, often overlooked influence of the portfolio mix. The scoring models are not merely counting the total number of your debts, they are meticulously categorizing them. They seek a balanced demonstration of financial competence across entirely different instruments, rewarding those who can successfully juggle both revolving lines, like credit cards, and installment loans, such as a mortgage, an auto loan, or student debt. This specific requirement reflects a deeply ingrained assumption within the risk assessment industry. The ability to manage a fixed, unchanging monthly payment over several years alongside fluctuating, open-ended balances suggests a sophisticated, multidimensional mastery of personal finance. It proves to the mathematical models that you are not merely surviving month to month on plastic, but successfully executing a long-term, structured repayment strategy. Number 4 casts the long, chilling shadow of severe derogatory marks and public records. While occasional late payments and high balances act as a steady, reversible erosion of your credit scores, bankruptcies and foreclosures are the seismic events of the financial world. These catastrophic markers bypass the nuanced calculations of utilization and age, delivering an immediate, devastating blow that can shatter a pristine rating overnight. The fallout from such events is radioactive, and it is not easily contained. A Chapter 7 bankruptcy, for instance, remains a glaring scarlet letter on your file for a full 10 years. It serves as a stark, unavoidable warning to any future lender, a historical monument to a past default that overrides almost any subsequent positive behavior. Until the statutory clock finally runs out, this single event will act as a heavy anchor, dragging down every mathematical calculation the algorithm attempts to make. Number 3 tackles one of the most pervasive and dangerous misunderstandings in the entire economic system, the myth of income. It is a deeply logical assumption that a higher salary, a massive inheritance, or a booming investment portfolio would automatically translate to a superior credit rating. Yet your income, your employment history, and your total net worth are entirely invisible to the scoring models. The algorithm is entirely blind to wealth. It measures only the mechanics of borrowing and repayment. A multimillionaire who frequently forgets to pay a minor $50 utility bill will possess a vastly inferior score compared to a minimum wage worker who meticulously manages a single low-limit credit card without ever missing a due date. The system is a strict meritocracy of reliability, a behavioral tracker that cares nothing for the size of your bank account, only the consistency of your promises. Number 2 uncovers a controversial strategic loophole often utilized to artificially inflate a weak profile, the authorized user status. This tactic, sometimes colloquially called piggybacking, allows an individual with a pristine, decades-long history to add a friend, family member, or even a stranger to their account as a secondary user. The moment this connection is made, the secondary user inherits the entire positive history of that specific card. They instantly absorb years of perfect payments and low utilization, grafting someone else's financial discipline onto their own fragile record. This practice essentially allows the transfer of reputation. However, the architects of the FICO and Vantage score systems are locked in a perpetual arms race. They constantly refine their algorithms to detect and dilute the impact of purchased or rented trade lines, fighting an ongoing battle between consumers trying to hack the system and the mathematicians desperately trying to protect its predictive integrity. Number one reveals the most powerful, yet least understood, force governing your financial identity: the algorithmic memory and the principle of time decay. The system, for all its ruthless calculation, is fundamentally designed to be forgiving, but it offers this forgiveness only on its own strict chronological terms. Time is the ultimate variable that heals all mathematical wounds. As a negative mark ages, its algorithmic weight exponentially diminishes. A missed payment from 5 years ago inflicts only a fraction of the damage caused by a delinquency that occurred last month. The formulas are explicitly programmed to prioritize your most recent behavior, operating on the foundational assumption that who you are today is a far more accurate predictor of future risk than the mistakes you made a decade ago. Ultimately, these scores are not moral judgments of your character, but complex, highly tuned probability engines. They are a reflection of human behavior translated into cold, actionable data. By decoding these hidden rules, the invisible ledger transforms from a terrifying source of anxiety into a navigable map, allowing you to master the very system designed to measure you.